Hello, my name is Raitis and you're here at Farewell Total Return Investing. And in today's video, we're going to go over the markets and make our weekly outlook. We're going to talk about DXY, T-bonds, gold, futures, and the equities markets. And I will also give you hands-on tips on how to navigate tight price consolidations, which we're seeing right now in the markets. And I can understand that you're probably frustrated with the current market conditions, and also maybe you're experiencing a period of drawdown. But today you will get hands-on tips on how to navigate these tight price consolidations and even increase your equity again. With that said, we will dive right into the charts and start with our weekly outlook. Before we dive into the video, I quickly wanted to update you guys that we have relaunched our Discord channel. You can join it in the link in the description below this video. You will get notified if we post a new weekly outlook and commentaries, and I will also do in-depth breakdowns which will not be posted on YouTube. So if you want to stay up to date, join Discord in the description. And now let's get into the charts. So as usual, let's start off with DXY. You can see we're on the monthly chart, and the first thing I outline is my weekly PDA levels. And we have this monthly SIBI right here, the high consequent encroachment, and the low end of this SIBI right here in the monthly time frame. And we also have the monthly old high, which can act as support and resistance level, even if we are not trading retail. Now let me go into full chart so you can see everything clearly. So these are my monthly PDA levels. You can see we are rejecting the SIBI high and currently trading at the consequent encroachment. So we're already, as you can see, we're stuck between two PD arrays, a premium PD array and a discount PD array on the monthly time frame. Now on the weekly time frame, you can see we also have this weekly SIBI right here. You can see we're also trading at the consequent encroachment of this level right here. Coupled with a monthly high, we have a weekly fair value gap, which we're currently rejecting, and also a weekly rejection block, which I forgot to outline. Let me quickly do this. And so we have our weekly rejection block. So you can see we are stuck between a bearish PD array on the monthly chart and on the weekly chart, and also on inside a discount array. That's why we are having, and this is why we're seeing these tight consolidations in the market, because we have trapped order flow. Market is respecting premium and discount arrays. Also, we have this weekly order block, but it kind of aligns with the consequent encroachment of this weekly fair value gap. That's why I didn't outline this level. Now let me go into the daily. We have the same scenario right here. You can see, you could say market is bullish. We're rejecting this order block, trade higher, run out the high, close above the high, but then we start to reject. Then we see market trade back into the bearish order block, sell off, immediate rebalance of this mitigation block or inversion fair value gap right here, trade lower, take out sell side. But we see no continuous run below sell side or buy side right here. Market reverses, trades higher from the volume imbalance, takes out the rejection blocks, trades lower, closes heavy. This was last Monday. Sell off, take out the low, trade back into the volume imbalance and the weekly and monthly PDA levels, and then reverses again. So you can see you can make a case for both sides of the market, which is an indication of trapped order flow and that market is inside a consolidation. Now, what I'm watching this week for DXY, it will be important how we close around this daily fair value gap today on Monday. And if we close above and can sustain the run higher after a stop run into a higher time frame discount level, which is a bullish sign, if we can sustain that run higher, then I would be bullish. And on the 4-hour time frame, We're also trading from the daily, consequent encroachment of this gap right now, coupled with a 4-hour fair value gap. So that's why if we lose this daily fair value gap, if we close below that on this daily candle, then I would reconsider my bullish bias. I'm currently 50-50 on DXY. You can see this is a massive consolidation since the start of the year. I'm 50-50, but I'm building base case scenarios for bullish and a bearish bias. And again, the case for the bullish bias is that we should close above the daily fair value gap to confirm longs. Also, we have a swing low forming with Thursday and Friday's candle and currently Monday's candle, so we could see significant expansion to the upside. And in consolidations, you have to be very, very conservative with your targets. Don't hold and swing for home runs. Don't think that the market will trade above these relative equal highs in like 1 or 2 days. In consolidations, this will never happen. Because let's say you would have gone short somewhere right here in this candle, and then you're expecting market to trade below this low, but it never does that because we have the rejection block where majority of the liquidity resides. Same here, if you would have longed the volume imbalance on the daily chart, you would have been in profit, but if your take profit is right here and not above the rejection block, which is also weekly rejection block and daily, then you would have been stopped out break even again. And this is not what we want. That's why in consolidations, your profit taking has to be conservative and your target levels as well. So this is key takeaway number 1 or number 2. We have trapped order flow. This was number 1. Market is stuck between premium and discount. This is a characteristic of consolidation profile or / seek and destroy. And we have conservative targeting and partialing. This is number 2 for consolidations. So I hope you have a notepad by your side and you're writing these things down, because this is really valuable and you could really save on some huge losses. And so now let's move on to T-bonds. So if we build the base case scenario that dollar is bullish, if we close above the daily fair value gap, then T-bonds of course should be bearish. So let's see. We traded into a weekly volume imbalance on T-bonds and we're rejecting lower. We have also this weekly fair value gap right here. And we have also a monthly redelivered imbalance, which we're currently trading in. And the protocol for a redelivered imbalance is that the next candle should see massive displacement to the downside. That's why I think T-bonds could sell off, which would allow dollar to rally higher. And if you look on the daily time frame, you could see, of course, we're also inside a consolidation. We were stuck between a discount array, which is the daily fair value gap, and we had the daily fair value gap right here. Or wait, we could use the high. So this is also a premium array. So we're consolidating inside this tight range since Monday, the 27th of January, consolidating for over a week, and then Wednesday only expanded higher. And now we're rejecting the weekly volume imbalance. So T-bonds are also inside a consolidation profile. Of course, you can say that they are bullish, but we only really saw 2 nice days of upside displacement, which was Monday and Wednesday. Now, again, we have a retail pattern right here that plays also into the confluence that we should see massive displacement to the downside, because we have a fake head and shoulders pattern. We have right shoulder, we have the head, and then we have another right shoulder. And this is the neckline. Retail traders, breakout traders, are trapped long with stop losses below this swing low right here. So this is where open float liquidity resides, and we would We saw rejection from the weekly volume imbalance on Friday, and another confluence is we closed above the daily fair value gap right here. And this is what I'm currently watching. I'm watching if we can see a sustained closure above this daily inversion fair value gap. And if we can even close below this propulsion block, below the constant encroachment. If we close below the 50% of this down close candle, then I'm definitely bearish. And I think we can take out this low where open float liquidity resides from retail who are trading this massive head and shoulders pattern. You can go and backtest this yourself in the price chart to identify these patterns, and you can see that this rarely plays out. So bullish DXY for a base case scenario, if we can invalidate the consequent encroachment on T-bonds of this down close candle, then I'm also bearish. And also, which adds to the confluence, we saw a SMT divergence. So if I'm going to pull up the 2-year Treasury T-note futures and overlay them on the chart, let me do this. And let me switch to line charts. So up here, you can see we have the 10-year Treasury note futures. And down here, we have the 2-year T-note futures. Market makes equal highs or even lower high on 2-year T-bonds, while the 10-year Treasury T-notes make a higher high. So this is SMT divergence, which also shows us that the 10-year T-note futures are being manipulated, and we're distributing and accumulating new shorts up here. So weakness is on the 2-year T-note futures. So if you want to be selling T-note futures, then choose 2-year T-note futures because they're heavily weak. And we already nearly traded below the swing low right here. I imagine that we could revisit this BC right here. Okay, that's that. Again, we are waiting for confirmation. So let's move on to gold. Gold is absolutely bullish, and we're at all-time highs. So what we're going to do here is we're going to do standard deviation projections to kind of give us a feeling where my market can trade up to. And I think gold can easily trade to the 3,000 mark. So this could be a upside objective because this is half of a standard deviation of this range higher. But again, all-time highs is also kind of a tricky situation to trade, and I would trade. I would have my bullish bias and just trade order flow until you get proven wrong and you see consolidation or retracement profile or even reversal profiles. But the thing is, if DXY is going to be bullish, if we get our confirmations for a bullish bias on DXY, and DXY could expand aggressively above buy-side liquidity, then gold will consolidate or retrace. That's the key part. If DXY starts to heavily expand higher and T-note futures are going to sell off, then gold could consolidate / retrace. That's the key point here, but we're seeing continuous bullish order flow, so gold is trending nicely, and the invalidation for a bullish bias would be this for our propulsion block right here, especially the consequent encroachment. So any candle closure below this level right here, which is 50% of this down close candle, would invalidate my long bias, and I think market could trade below this low and maybe even this low, because this is also again a head and shoulders pattern, fake head and shoulders pattern. Now let's go to the equities. Very interesting. Again, equities are also inside a nasty consolidations, and yes, please avoid all of the lines. I know it can be confusing, but we can switch them off because we don't really need them. Because on the monthly time frame, we don't have a lot. We have this monthly order block high, monthly order block consequent encroachment, and the open right here. Weekly, we have this consequent encroachment of these two down close candles, which is a weekly bullish order block. We have this fair value gap, and we have the high of the order block. And of course, this buy side liquidity pool, which is my main target objective because I'm still bullish on equities. My bias is bullish. Again, what can we see here? Since basically start of February, you can see we're also running sell side and buy side, and we see no continuous delivery on either side of the market. That's why we have to be conservative with our profit taking and also daily target objectives. And you have to set expectations. Now, my expectation for equities, again, my base scenario for a bullish bias was that we didn't trade below this 4-hour propulsion block right here on ES. You can see market opened gapped lower and immediately closed back above the propulsion block. So this for me is fine. But if we see a candle closure below this 4-hour propulsion block, then I would be very, very careful with longs. I have still my 4-hour liquidity draw right here. Again, remember, we are close to equilibrium of this dealing range on the 4-hour time frame, which is this whole down move from last week where we gapped lower. Massive gap. So if market returns back and closes below the 4-hour propulsion block and starts to consolidate, then this is extreme low probability because we are at the equilibrium of a dealing range and we basically have trapped order flow. Again, on the daily, we have trapped order flow. Market is not willing to trade past this daily volume imbalance and not also past the daily fair value gap. So it respects both premium and discount rates. Again, another confirmation for trapped order flow and consolidation profile. I think you already get it. I already showed you this on DXY and on T-bonds. The only asset that is trending is gold, where we have sustained and clear bullish order flow, where we only respect bullish discount PDRAs. So again, this is our invalidation criteria. Same goes for NASDAQ. We have this 4-hour propulsion block on NASDAQ. We again get lower, but immediately close back up. So if we see displacement higher, then I'm still inclined for longs. We have these relative equal highs right here and the weekly rejection block. Now I forgot to mention my target on ES. Again, we want to target conservatively because market is not showing sustained displacements. That's why I will be targeting the rejection blocks, or basically the daily volume imbalance, okay? So this is my target for the week for Monday, Tuesday, and Wednesday. Wednesday, remember, we have CPI news, so be mindful of that. And again, same criteria for NQ. Now, this is where it gets a little bit tricky because we have E-mini Dow Jones, where we had actually relative strength on YM, but now I'm not inclined to trade YM anymore because you can see Thursday's candle was bearish, Friday's candle was bearish. ES, Thursday's candle was bullish and Friday's candle was also bearish. Okay, Friday was overall bearish, but Thursday's candle on NASDAQ was bullish and Friday's candle was bearish. But YM had two down close candles. And we saw a deeper retracement on YM. That's why, and we also closed. This is a normal fair value gap. This is not a busy. This is just a normal daily fair value gap. So it can close below the daily fair value. Don't get me wrong. We also traded into the monthly order block mean threshold right here again. And also the weekly inversion fair value gap of this SEBI right here. So again, if today's candle can close back above the daily fair value gap, or at least inside the range, then I'm still bullish on YM. That's no problem. Again, this is my criteria. And then on Tuesday, we could maybe look for longs, because right now this is a stop run into a higher time frame level. So this could even be the low of the day when we see a straightaway rally. So yeah, this could be the case, but again, I would want to see how today's candle closes, and if we can really hold the propulsion blocks on NQ and ES. Again, we have a run on sell side liquidity into higher time frame key level. So again, if we get our confirmations, then we can safely long. This doesn't mean we will be profitable with every trade, but we can safely long into this H4 liquidity draw and H1 liquidity draw above this high. Again, this wraps up the video. Again, aim for 1 to 2 setups per day. Now let's quickly go at the end of the video to the economic calendar. Monday, we have some Euro medium impact news. Tuesday, we have something for London close, but I don't think this will be too impactful because this is only a speech. And then core CPI and CPI news release for US dollar. This is the main economic news release for this week. And then, of course, unemployment claims and PPI on Thursday. This will be also very interesting. So I hope I can position myself in the first part of the week, and then maybe we can see some extravagant movements on the XY to the upside, where we finally break this consolidation from January going into February, and maybe we could even run up extremely aggressively above this buy side liquidity with CPI and the volatility included. So with that said, on Friday, we have also an 8:30 a.m. news release. Again, the key takeaways, again, I hope you wrote down what I said in this video. So, trap order flow characteristics are market respects premium and discount arrays. This is trapped order flow. Then I'm looking at my notes, just by the way, so I ticked off everything. And then we have conservative targeting. Don't aim for swing highs and swing lows. For ultimate targets, use rejection blocks as targeting. Scale off some partials at rejection blocks, and you will do yourself a favor, and you will earn much more money and have less losses, and you will have less break evens because you're holding for ultimate highs, and then market reverses at the rejection blocks and stops you out. Break even, or even with a stop, that would be even worse. So use rejection blocks for partialing. This is number 2. And then be very selective with your trades. Aim for 1 or 2 good setups a week, and don't push hard in these conditions, because you have to decipher as a professional trader in which conditions you want to push yourself, your edge, and in which you want to really be conservative, preserve equity, and focus on sustained equity growth. And then one point not that I forgot to mention is that you set, like I did, as you saw, scenarios. So if market does XYZ, I will do this and that. I will be bullish, like I did for DXY. If market closes today above the daily fair value gap, I will target this daily rejection block for tomorrow. So set yourself scenarios for bearish and bullish biases in consolidations, and then act only on these expectations, because then the market cannot surprise you, whatever it does. Because if the market closes below the daily fair value gap again and rejects it, then we could see a run below the sell side liquidity. This is my expectation. So I have scenarios for a bearish and a bullish bias, and that's what I advise you to do, because you will not act out of emotions. You will act from expectations you have done the day before, and you will be less emotional in your trading. So with that said, I hope you enjoyed this video. Please, you would do me a favor if you like and subscribe to this channel. Check out the Discord channel where you will get exclusive insights into my trading and analysis. And with that said, I wish you a pleasant week. Stay safe, trade safe, and we will see us in a daily commentary, probably this evening, where we go over price action in a shorter video, 5 to 7 minutes. And then I hope I will see you there. So subscribe and activate the notification bell so you don't miss out. Bye bye.